Look around any active construction site or agricultural operation today, and you will see a vehicle dominating the landscape: the modern double cab pickup. It offers the heavy listing utility of a flatbed, combined with the comfort and seating capacity of a passenger SUV. Since 2002, this dual-purpose nature caused no friction in the tax code. HM Revenue and Customs established a pragmatic rule. If a pickup could carry a payload of 1 metric ton or more, it was automatically classified as a commercial vehicle. That simple metric allowed business owners to operate high-specification trucks while paying the tax rates of a standard panel van. However, the recent autumn budget has officially eliminated the 1-ton payload test for direct taxation. Instead of a strict weight limit, HMRC is implementing a qualitative standard known as the primary suitability test. To pass, a vehicle's construction must be primarily suited for the conveyance of goods. But because modern double cab pickups feature a second row of seats, 4 independent doors, and premium passenger amenities, they are equally suited for carrying people. They lack a dominant commercial purpose under the scrutiny. By failing to prove an overriding commercial utility, the double cab pickup legally defaults to car status. This replaces the simple weight-based classification that has defined the market for over 20 years. The foundation for this policy shift traces directly back to a 2020 Court of Appeal ruling involving the Coca-Cola Company. In that case, the court determined that multi-purpose crew cab vehicles could not be classified as vans. The justices ruled that without a clear predominant suitability for carrying goods over passengers, a vehicle must be taxed as a car. HMRC initially hesitated to apply this logic to the wider pickup market. They issued guidance reclassifying these trucks early in 2024, withdrew it a week later after severe industry backlash, and then permanently reinstated the policy in the autumn budget. The legal baseline is now absolute. Under the law, any structural ambiguity in a vehicle's design purpose guarantees it is treated as a passenger car. This precedent removes the comfort of the 1-ton payload metric. Businesses can no longer rely on quantitative capacity. They must evaluate their fleet vehicles strictly on qualitative design. In 2025, the double cab pickup enters a contradictory state across 4 tax domains. VAT remains fully reclaimable if payload exceeds 1 ton, and vehicle excise duty holds at £345. However, for direct corporation and income taxes, it is strictly classified as a passenger car. This creates an immediate administrative burden. Fleet accounting ledgers must now track simultaneous contradictory compliance data for a single physical asset. Operating a vehicle with 2 opposing legal classifications means that precise accounting matrices are no longer optional. They are required to survive future HMRC audits. On April 1, 2025, new corporation tax rules strip these vehicles of their plant and machinery classification. This causes an immediate financial casualty: the complete elimination of the 100% annual investment allowance previously used to deduct the entire purchase price in year 1. Instead, double cab pickups are pushed into the standard writing down allowance pools. Because diesel trucks have high CO2 emissions, their capital allowance rate is strictly capped at just 6% per year. A company buying a £60,000 truck can now only deduct £3,600 against their taxable profits in the first year, leaving the vast majority of the cost unrelieved. By removing the ability to offset the upfront capital expenditure, this change increases the net cost of acquiring a pickup and restricts early-year cash flow. Just 5 days later, on April 6, 2025, the timeline triggers the income tax and benefit-in-kind reclassification. This ends the flat commercial benefit-in-kind rate. Under the old rules, providing a pickup to an employee for personal use generated a fixed taxable benefit value capped at roughly £4,020. Benefit-in-kind is now a ruthless equation: vehicle list price multiplied by its CO2 emissions bracket. A £60,000 diesel truck at the maximum 37% bracket yields a $22,200 benefit value. For a higher rate taxpayer, their personal annual tax liability spikes from £1,608 to £8,880. Employers face parallel costs. Companies are hit with higher Class 1A national insurance contributions, calculated directly from those newly inflated benefit values. A 450% tax spike on both sides of the payroll makes providing traditional diesel double cab pickups financially untenable for most operations. To prevent an immediate financial crisis for fleets already on the road, the government has established specific transitional grandfathering arrangements. The qualification boundary is strict. To secure this relief, a double cab pickup must be officially ordered, leased, or purchased prior to April 6, 2025. Qualifying vehicles will retain their advantageous commercial benefit-in-kind status until they are disposed of, their lease expires, or they reach a hard cutoff date on April 5, 2029. There is a critical caveat for capital allowances. Even if a contract is signed before April to secure the 100% annual investment allowance, the actual expenditure must be incurred before October 1, 2025. HMRC has clarified that internally transferring these grandfathered vehicles between employees within the exact same company does legally preserve the commercial tax status. Fleet managers are operating against a rapidly closing window. Executing binding contracts before the April deadline is the only remaining mechanism to lock in multi-year tax efficiencies for diesel assets. For companies looking past the April deadline, the next viable frontier for corporate fleet procurement relies on different vehicle categories. The first compliant alternative is transitioning the fleet to single cab or strict extended cab vehicles. Because single cabs lack a rear passenger row and 4 independent doors, their primary suitability remains locked to goods transport. They pass HMRC's qualitative test and are unaffected by the new laws. The second alternative requires abandoning the internal combustion engine and investing in electric double cab pickups. This exposes a highly efficient loophole. While electric pickups are still classified as cars under the new rules, zero-emission vehicles attract a benefit-in-kind rate of just 3%. This preserves thousands of pounds in tax savings, especially when procured through a salary sacrifice scheme. Moving forward, future corporate fleet procurement will be entirely dictated by a clear choice between strict cargo utility or aggressive electrification.